This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Philippe, welcome back. I'm honored to have you on and to continue segments into syndication. What is syndication and some details that aren't talked about enough, I feel like. I want to dive in more today, right? And even deeper into, the responsibilities of the syndicator or the investors and even how they profit from a syndication, right? And talk about the structures of some of these deals a little bit. And so I know the investors who were learning yesterday, whether they're active or passive, you're going to learn a lot more today and tomorrow as we dive in. So tell us a little bit more about the responsibilities of the operator that we should be aware of. And then let's dive into your responsibilities potentially of the investor as well.
Yes, sure. Thank you, Whitney, for having me back. So the responsibilities of the operator is going to range, it's anything that is active on the deal. So it goes from obviously finding the deal, making the underwriting, putting the deal under contract, and then do the due diligence on the deal. Obviously you want to make sure that your business plan or the business plan that you're going to develop is confirmed by, checking, getting an estimate on different expenses, getting quotes for insurance, for repairs, etc. And that's how and also look at the rents in the market, look at sales comps. You want to firm. The sponsor is going to firm their business plan at that point. And usually by the end of the due diligence, they're going to make a decision. Is this deal, are we going to close on this deal? Are all our assumptions have been confirmed and it's a deal worth presenting to our investors or not? So there's go, no go decision. And by that time, they will have studied the deal probably for between 15, 30, 45 days, they will have spent day in, day out looking at the deals, at the different aspects of the deal, working the deal with contractors, with a property manager, etc. Build a team, with the lawyer, the lender. And then it's time, when the decision is made to go and close on that deal, you're going to work with the lender, send an application for getting a loan and so on, and start work with your SEC lawyer to do the paperwork, the private placement memorandum and the operating agreement for the company. And then, you're going to present the deal to your investors. So, it's typically, it could be a webinar or could be a recording or just some kind of PowerPoint. That's how you're going to introduce the deal and, spread the word, right? Send some emails, text messages and whatnot to the investors and to get interest. And, what the sponsor will do is really show the highlights of the deal there. Those are the type of returns. This is why we think the market is a good market. This is why we think this deal, the business plan on this deal is very likely to succeed. So that would be pre-close. You're going to receive the money from investors, put in an escrow account until the day you close the real estate transaction. And once you close that transaction, you'll have your property manager take over the deal. And after a few weeks, you'll be able to see how the deal is doing. You'll send updates to your investors and also distributions, right? I mean, that's why we are doing these investments. And the sponsor will oversee the asset, and that's what we call asset management. That's another responsibility of the sponsor. So, fast forwarding to the disposition phase, so let's say there will be a capital event eventually. So the capital event could be a refinance. So the sponsor obviously will work with the lender to get better terms on the loan and be able to get some cash out that we can send to the investors. Or it's purely and simply, a disposition. And often, what happens is by improving efficiencies, doing renovations, you're going to increase the net operating income of the deal. And in commercial real estate with the cap rates, it will, directly and proportionally increase the value of the deal. So you'll be able to capture a huge part of the returns at disposition.
Sounds like the syndicator, the operator has a lot of responsibilities, right? I mean,
right.
I would say that's even a short list right there, right? Of all the things the operator has to be doing and juggling, or their team has to be responsible for and be experts in, right? I know I personally am not and would not claim to be an expert in all those things you just mentioned, right? But I do have to have people on the team that are, right? And that's what makes an amazing team as well. And I think that even goes back to the conversation yesterday about, do I have the skill sets to keep buying single family units or doing all those things myself? Could we do it? Yes. Is that the wisest thing for everyone? Probably not, right? When you consider the time invested, man, and all the things that Philippe just mentioned, I mean, it's so much time. But I want to move on because there's a couple other things that I want us to have time to dive into today. But what about responsibilities for the investor? Anything they should know, or responsibilities for them as they invest passively in a syndication?
So I think there's a legal aspect, which, I can touch in a minute. But first, I would say the responsibilities for the investor is, like we've mentioned yesterday, you have to vet the sponsor, right? So, get to know the sponsor and look at their track record, talk to them, see what kind of materials, usually they'll have blog posts, they may have some videos or podcasts and whatnot. You want to know them, what they're about, right? What's their values? Again, what's their track record? And, what's their why? Are they there for the money? And, they have like a larger purpose. I think it's, typically if it's only like they talk about money, it could be not necessarily a good sign. So that's, vetting the sponsor. Then you want to take a look at the deal. And it's good to, look at the typical, what type of returns are you looking at? What kind of splits between the sponsor and the investor? Make sure that your interests are aligned, between the sponsor and the investor. There are some cases, if there's a pref return, for instance, in some cases, it might make sense for the sponsor to sell or refi as soon as possible, but is it optimal for the whole deal? There's some questions to be asked there, and at least, understand, have that discussion with the sponsor, what they do. Now, on the legal side, the investor have to review the private placement memorandum. Then they have to, so obviously, like we mentioned earlier, there are a lot of pages, but, I think once you've read one, they're all pretty much similar. So, I would do the exercise one time, and then you can focus on what's important, like the splits and preferred returns and hurdles, if any. And so you'll have to fill a subscription agreement as well. And finally, you will have to wire your funds. Those are your responsibilities. And just stay on top of the deal by reading the monthly update.
I love how you even brought up the PPM, the private placement memorandum. It is that document that you mentioned that has all those risky possible outcomes, right? And it's just to ensure that, hey, we both know there's risk to any kind of investing, right? People say, oh, is the pref guaranteed? I say, well, absolutely not. I say, well, what investment have you ever made where it was guaranteed, right? I don't know.
Exactly.
Right? None. And so we're all trying to reduce risk as much as possible. And that document helps to just ensure that, hey, we both know the risks of everything that could possibly happen, but it protects us both as well. I think you mentioned great. It's like, spend the time at least once to read through it. Yes, 100+ pages, but you're going to be so much better educated about how these deals work because of that. And then you're going to learn, hey, go back and on next deals, you may not have to read all of that. So much of it is the same. However, you do need to look at things like, how are the distributions handled? What is that process? It will lay out exactly the distribution flow of who's getting paid first down. Many layers, right? You need to see that as the investor. What happens if there's a capital call? Who's in charge? Or what happens if that person, unfortunately gets killed or dies, and who's in charge then, right? And you need to look at some of those things and ask some of those questions that Philippe has laid out here. But Philippe, you also mentioned, you talked about the structure a little bit, and let's dive in there a little bit. How does the passive investor look at the structure? How do they choose that syndication structure that maybe makes the most sense for them? And maybe talk about a couple of different ways that maybe a deal could be structured.
Yes, sure. So from a structure standpoint, you have like the typical, very basic structure. You're going to have a split of the returns between the general partners. So as we mentioned earlier, with all the responsibilities that the sweat equity and the limited partners. So it could range from, a very basic, 80-20. It could be 60-40, anything in between, or even better, meaning, so 80-20, for instance, it's 80% for the limited partners and 20% for the general partners. But depending on what type of returns, the general partners might decide, and it might still make sense for the investors to have a larger share for them. But then, you have other types of returns that can be added, such as a preferred return. Now, the preferred return, the way it works is if you do, for instance, an 8% preferred return, is that before you do the split that I mentioned earlier, you would give the cash flow would go to the investors up to 8% on yearly basis to their investment. So if you invested $100,000, that would mean that you should get $8,000 on any given year. And if the deal doesn't have enough cash flow to generate this amount of money, then it's going to, whatever is missing will be set on side and it will be paid at disposition.
Yeah, no, that's great. That even brings up even a point to the last point about the PPM. Like, you need to look at those things, right? What happens if they can't make the distribution?
Absolutely. Yeah. How the money is going to be set aside and when are you going to be paid? Absolutely. Yeah. And there are other things that, from a structure standpoint, there are also hurdles that could be made, meaning that the split may change once a key metric is reached, such as it could be, for instance, the sponsor has doubled the investor's money in a particular time frame, then anything and, up to that point, the split could be 30% for general partners, 70% for limited partners, but above the 2x equity multiple, doubling the investment money, it would go 50-50, for instance. So that's another structure on the splits that is possible.
So what feedback do you hear from investors, Philippe, from that right there? Should they be discouraged because their split is getting less, or should they be okay with that?
I think they should be okay with that, because I think that's probably the ultimate way to provide incentive to the general partners to have the deal perform very well. Because the more returns, and especially if you think about it, if you can double your money into any investment, I think that would be, and the typical hold is what, 4, 5, 6 years. I think that's a pretty successful deal at that point. And now you're saying, well, look, you double my money, I'm willing to give you more, Mr. Sponsor. And I think it makes sense. Now as a sponsor, I'm very motivated to make that happen. 100%, hands down. And especially, again, when you have the pref return that is in place, as we mentioned, all the cash flow is going to be directed to the investors. And at that point, it could be, there are not a lot of deals these days that are making 8% cash on cash. So it means, there will be a good period of time where the sponsor may not receive a lot of money at all. So I think the hurdle makes a lot of sense to provide incentive for the sponsor to make the deal work very well and provide returns to the investors.
Yeah, for sure. No, I couldn't agree more. Yeah, it does incentivize them to perform, right? And to make that deal work as efficient as possible. What about other questions that you might encourage an investor to ask before investing in a syndication? Anything else that you would think about, or even, as you've learned a lot more about the syndication business now, you probably have a lot better questions to ask that sponsor before you invest.
Actually, and I think what comes to mind is a question that as a sponsor, I ask the investors. And, it's amazing in some cases, like, I remember talking to a couple one time, a young couple, young professionals, and I came to realize, they were telling me, we could invest $50,000, but, we need some time to bring the money together, etc. And, throughout the discussion, I realized that was pretty much, young couple, young professionals, that was all their savings. And I told them, no, I don't think it's a good idea at this point to put all your savings into one deal. Even though it's real estate, like the risks are lower, but who knows, what can happen? If you have like a black swan event like COVID, it could be something else in the future, who knows? But you don't want to have all your money tied up in one deal. And that's where, you have to invest in a smart manner, and you don't want to invest like all your eggs in the same basket. So that's one thing that investors should consider. And I think it's okay, it's okay in that case to ask the sponsor, say, look, can I know like the minimum investment is, for instance, $75,000, but really I'm comfortable with investing 25, is it okay for me to invest lower amount? And I think, once the sponsor understands the circumstances, they will probably let you in. Again, if they're not all in for the money, they should, in my opinion. Another question that an investor should look at is, I think it's really going back to the sponsor, what's their experience, how many deals they have done in that market. In my experience, working with different groups, and that's how I grew my knowledge and my own experience, the most successful sponsors is the one who are repeating deals in the same markets, right? Maybe you want the sponsor to have like 1,000 units in a specific market. But if you take the concept of, you don't want all your eggs in the same basket to a higher level, maybe you don't want to keep investing with the same sponsor over and over again because they're going to be in the same market. And who knows, something can happen in that particular market. So it becomes interesting to go and work with different sponsors which are in different markets, or with groups who are working as co-sponsors, with experienced sponsors in different markets. That's how you can diversify your investments in different markets throughout the nation and avoid, any downturn or any critical thing happening in your portfolio in case something happens in that particular market.
For sure. I think that's a very wise words. It's like, don't have all your eggs in one basket, right? Drop the basket, you know what happens? You don't get breakfast, ultimately, maybe for a few days. But no, that's great. And I think every investor, especially when you're first starting, and even as you have invested in numerous deals, you need to think about that. There's many ways you can diversify, even as you grow and through different operators or, different asset classes and all those things. What about, what's your worst real estate failure, Philippe?
Yeah, so early on, so I mentioned I did my first 2 deals. Then the third deal, actually, I happened to become a mentor on that deal, on leading that deal to close. And our first deal, we became a little bit more ambitious, look after a $30+ million deal. But there were several features on that deal that were kind of a little bit unique. It was a new market for us, larger deal. We decided to work with an equity partner. And I think it was not wise for us to have this new business plan altogether on this larger deal. And while we were led to believe that we had like several backups at the several layers, when we came close to the closing table, a few weeks away from closing, the equity partner bailed out on us and we ended up having no real backup. And, several partners, obviously, including myself, we lost a significant amount of earnest money on that deal. But, I think it's part of learning. In that case, was a very expensive learning experience, and I think that's where, now, because I do mentor as well, I'm helping students to stay away from these more risky ventures and try to steer them towards something that is more mainstream, something that we have experience with. You don't want to be the first necessarily to try a new business plan. And, interestingly enough, other groups with whom, I worked at that time, they experienced the same failure, interestingly enough, right? And it happens all the time, actually, where you're going to lose earnest money deposit. I mean, these days it's because of financing. If you came into a deal with some business plan and you expect the debt to be at this point, as we know interest rates are raising right now, well, sometimes the deals, they don't make sense anymore. And the risk is if the seller doesn't want to retrade, you're going to lose your earnest money deposit. But see, this is a failure for the sponsor. It's not something that is going to be reflected to the investors because at that point, the investors, they didn't engage any money.
Yeah, no, that's a great point as well. It is a risk that the operator's taking, right? With typically their own capital, or it may be a partner or two, in the beginning when you're first getting started, but thankfully it doesn't affect the capital most times of the LP or passive investor. Let's dive into what led you to start a fund.
So that's a good question. Thank you for asking. We decided to create a fund because I think it's a matter, and just to step back for a minute, a fund, I think you have to think about it as a super syndication, right? Meaning instead of, one syndication being for one asset, in a fund, you can have multiple assets and you can invest in different ways into different assets. And I think that's what is the power of the fund, is going to offer you diversification as an investor. But there are different types of funds. I think there could be a blind fund, meaning that, you're going to really 100% let the sponsors of that fund, pick the assets for you. They will obviously outline the characteristics of what assets they're going to pick, but you really don't have control. What we decided to do is to do a customizable fund, which allowed investors to pick and choose within the fund what assets they want to invest in. So now, we started this fund, this customizable private equity real estate fund, to our investors, this flexibility to invest, but also to have like a single, one-stop shop for all the paperwork, such as the private placement memorandum, the portal to access your investments, as well as your tax returns, and offer diversification. And now we come ourselves, as typically as co-general partner in deals, and we're going to partner with different sponsors who are experts in different markets. And so, the investors can trust our experience and background and past successes in selecting the best sponsors in different markets and bringing deals that we vetted, from sponsors that we vetted as well. So that's why, we did the fund. Also, having a fund, it gives us the flexibility, and it's more, I would say, technical and on the sponsor side, but to come into a deal as a general partner or co-general partner, we can also come as limited partner or JV partner. So, and it's more like really on the structure side and how the different partners come together. And in some cases, really like the very experienced sponsors, they don't necessarily give a lot of option. And we're going to come as a fund and say, look, we can bring so much capital in your deal, give us better terms that we can pass to our investors. That's how we approach the discussion with the sponsor at that point, to bring value to the investors, as well as getting better terms from the sponsor and very experienced sponsors who may not offer the ability for other people to partner with them except through a limited partnership.
Yeah, I appreciate you elaborating on this type of fund, and you call it a customizable, private equity fund. Or you mentioned like investors get to pick and choose the deals they want to invest in. Can you just walk through that process a little bit, and how do they do that?
Yeah, so we have a portal, and so investors can sign up. And so it's a 506c fund that we created. So it's for accredited investors only. But once they sign up and we review that, they fill their application and we verify that they are accredited, they have access to our offerings. And, fund, we're going to, every few months, it could be 3 to 6 months, we'll add a new deal into the fund. And then, the investor can decide, yes, I'm going to pick that fund, so they can review the specifics of the deal, the returns, the market, and we'll do a little presentation about that specific deal, like a traditional syndication. And if the returns profile and the deal profile fits the investor's requirements, they can select that investment to be part of where they deploy money. And I think at the end of the day, for them, it's very similar to investing in separate syndications, except it's like a one-stop shop. So they would deploy money into, let's say they decide they would send money to the fund on deal by deal case. They're not sending like a big check that is sitting there. So they would say, okay, I want to invest 50,000 in this deal. And then there's a new deal coming up that they like. So they can send another 50,000 into the fund. And then when the deal is going to close, be disposed of, either they can take the funds out, or there will be by that time another opportunity for them to invest in a new deal, right? And it's the same thing for their distributions. We're going to offer in the fund like debt opportunities, for instance, right? So it will be like a super savings account where they can just make their returns, their distributions sit there and collect even more money. So yeah, we think we have a good customizable private equity real estate fund. Is a good solution for investors to be able to diversify their investments and build a relationship with one team, rely on us to vet, separate deals, separate sponsors on their behalf.
We've done almost 1,500 episodes, and I don't think we've talked about like a customizable fund like this. I don't know, maybe once or twice before, so I like this model though. I like how it's a multi-asset fund, and, it does give the investor, like you mentioned, the option to invest again in that fund, but on a deal by deal basis. It's kind of like a blend almost of a multi-asset fund and a single asset fund. It's interesting how the investors have that option on a deal by deal basis, but it's the same fund. And so I like that. And they get to determine their risk tolerance for each deal individually, right? In this big fund. So it's an interesting model. We've not looked into that specific kind of fund, but I want to learn more about that and how that functions a little bit. Are you able to manage all that through an investor portal? Is that something that a portal can handle as far as, those decisions that investors are making on a per deal basis in a large fund like that as well?
Yes. We have a partner, who made these capabilities available to us. So we're working with them. Our fund is hosted by that partner. And, you have all the features, the back office features that allow, for the individual investors to invest in individual deals and to, for the distributions to be sent in the right places. And actually, we also have another feature in the fund, because with my partner, we're going in some cases to pre-fund the particular investment. So again, for us, it's one of the tools we have to work with different sponsors and say, for instance, my partner and I, we have $500,000 in the fund, and we'll knock at a sponsor door and say, look, we can deploy this $500,000 that is in our fund tomorrow. The idea, we pre-fund it with my partner, and we're going to backfill this position with investors' money down the road. But, what kind of terms do you give us? We come very strong to, at the negotiation table to ask for better terms. And, we're not coming with, we think we can bring such and such money to the table. Or we think, we can find investors and fund in 30 days. It's like, we agree on the terms and we can wire the money tomorrow. So, again, you have a lot of flexibility with our fund, a lot of tools to be able to negotiate the best terms possible for investors.
Awesome. Philippe, we're going to go into a few final questions as we close this segment out. And I want to ask you, what's your best source for meeting new investors right now?
Well, so, we recently started our new company, Boost Capital Group, when, my partner, Jeff Rodriguez, and I came together. So we launched earlier this year. And, right now, the best source is, one of the things I'm not less comfortable doing, I don't know if it's a generational thing or something else, but it's like posting on social media. So, we decided with my partner, we really want to have like a thought leadership platform. We want to spread the word and post on social media and get people to know us through that mean, share information and education with people who might be interested. And that's how we hear, we spread the word and people get interested, and it could be a podcast appearance like doing right now. And people get back to us and say, I like what I hear when I see you. And I think that's probably, a strong source for us of new investors. But otherwise, there's the traditional, meetups and conferences, real estate conferences and other, networking groups, etc.
What are some daily habits that you are disciplined about that have produced the highest return for you?
On daily habits, I'm glad to share that, when I started to do real estate full time, I quit my W-2. I started to exercise more consistently. And I think that was very good for my body. And, I like to take like brisk walks and I listen to audiobooks and I think about it as well. And actually, sometimes my mind wanders when I'm taking these walks and, I get ideas of how to resolve some issues. And I think it serves that a little bit, it's both physical exercise as well as a mental, some kind of meditation, I think to some extent. And, I think it's a very, very strong, habit that I took a few years ago. I'm very glad I started.
What about the number one thing that you would say has contributed to your success?
I think it's two things, I would say, consistency and perseverance. consistency, define what and that's what I keep saying to my students, my mentoring students, define your criteria, and discuss with a mentor, what you're looking for instance, and whatever. And I'm, taking real estate as an example, but it could be in any business that you want to start, define your goals, define your criteria of what you're looking for, and keep focusing on that, become an expert on, maybe it's a market in real estate. It's a 100 plus units in Atlanta where I live, for instance, and become the expert. When you have seen enough of those deals, you'll be an expert eventually, and you'll see that particular deal that is, like a good deal, or the best deal you've seen so far. And that's the deal you should make your best effort to get under contract. And myself, I suffered of, shiny object syndrome, right? Or like the dog with the squirrel, always looking at something else. Like focus and consistency is very important. And then, perseverance, because it will take tens, hundreds of deals for you to review until you find a deal that will fit. So you have to be patient, keep at it, and, eventually you'll find an opportunity.
Now, even you talking about that, one of the worst real estate deals, what happened with you, you didn't stop there, right? You didn't quit, you persevered, and
Absolutely.
The next one. And if you hadn't, man, what a loss it would have been, right? But you persevered and you kept going. And so, Philippe, it's been a pleasure to meet you and have you on the show. You've provided a ton of value over the last 3 segments to the listeners and myself. I'm grateful. Tell the listeners again how they can get in touch with you and learn more about you.
Yes. So they can reach out to me at my first name, Philippe, Philippe, at boostmycapital.com. That's my email address. They can also take a look at our website, boostmycapital.com. And on the website, they can download 5 ways to invest your retirement money when we're comparing the stock market and real estate and other investment opportunities as well, if they want to know more about us.
Thank you for being with us again today. I hope you have liked and subscribed to the show. Please tell your friends about the Real Estate Syndication Show. And I hope that you are learning and growing. Don't forget to go to lifebridgecapital.com where you can start investing today.